Welcome back. Brian the Mortgage Savage here, and today we're going to be talking about the 5 disadvantages of a VA mortgage. Five disadvantages of VA mortgage. Number one is that you will have less equity. When you put down 0%, you have no equity in a property. And some people may find that to be a disadvantage if values go down. But historically, values have always gone up. So if you're in a short window where you're going to own the home for a short period of time and values go down and the market hasn't had a chance to recover, that could be a disadvantage. But for the most part, over history, values go up on houses. So having no equity in your home is considered a disadvantage in a market that is decreasing in value. Number two is VA loans cannot be used for vacation homes or rental properties. It is for primary residences, and as such, you can buy 1 to 4 units as a primary residence as long as you're going to live in that property. So not good for investment properties or rental properties. The investment or rental, that's the same thing. Second home or rental. Second home is something that you use for your family and friends. Can have a housekeeper or cleaning service come in and clean after their visit, but you're not collecting rent. You're not charging by the night. You're not charging by the month, which would be an investment property or rental property. So that's the difference between those two. The third disadvantage to VA loan would be that seller and realtor resistance to VA financing. Because it's not used very much, usually 2 to 5% of all mortgages are VA mortgages. As such, sellers and realtors are not as well versed in them, and there are some complexities, added layers of protection for the buyer that could affect the seller in that when the appraisal is done, the house has to meet minimum standards of occupancy, and things that people may or may not want to update or repair or make sure that are safe prior to listing their house could get called out during an appraisal inspection, and the seller could be required to repair, replace, or upgrade those things prior to closing. Areas of concern is the roof have at least 2 years on it. In the state of Florida, the insurance companies require that you have 3 years of roof life left. Any type of wood rot, mold, mildew, so whether that's in the bathroom, around the refrigerator, freezer, seal, fascia around the outside of the house that has dry rot or fungus, those kinds of things would need to be replaced or repaired or cleaned. All doors and windows must open, close, lock as designed. Cannot have windows nailed, painted, or barred shut. Even if you're trying to keep people out, have to be able to get out of the house in an emergency. Any type of walkway, stairs, flooring can't be a trip hazard. So I must have a handrail, so safety issues there. And let me think what else. Any room that you're sleeping in must have heat. And if the heat source is a air conditioner heater unit, like a heat pump, the heat and air must both work. Any appliances that are installed in the property must work. So stove, refrigerator, dishwasher, oven, stove, cooktop. If they're installed, they must work. And I think that's pretty much it. Cracking, chipping, peeling paint. That's same on FHA and VA. If there's cracking, chipping, peeling paint, that has to be cured and remediated and taken care of prior to closing. So those are some things that seller may resist. The other thing that they may not be open to, and so you have to find buyers and sellers that are open to it, is seller pay closing costs. So when you buy the house, the seller's expecting to get so much for the house, and when you ask for seller pay closing costs, that takes away from the amount that they have anticipated getting back on the house. So they may be resistant to that, or may not be willing to pay those. And then Number four, disadvantage number four is the funding fee, the upfront funding fee that the veteran pays for the property is higher on subsequent uses than it was on the first use. So first use, you're paying for active duty like 2.1%. On subsequent uses, it could be as high as 3.3% for second, third, fourth use. Realize you're putting nothing down, and if the seller's paying your closing costs, you're bringing nothing to the table. So that upfront funding fee is a type of insurance. It's not private mortgage insurance or mortgage insurance, but it is a type of insurance for the VA to allow this program to continue being zero down, and that it helps cover the costs of losses through foreclosure, short sale, and deed in lieu foreclosure. And then number five is that not all lenders offer or understand VA loans. So case in point, I had a client come to me, and veteran wanted to use the VA benefit and went to his credit union to get pre-approved, and they're like, no, you don't want a VA loan. No, no, don't do a VA loan. They're horrible. And come to find out that bank did not offer them. So rather than say we don't offer VA mortgages, they talked down the VA mortgage so the client would not leave the bank and go somewhere else to get the loan. I ended up closing the loan for the veteran. He went in with zero down and zero closing costs, no money out of his pocket. The loan that the bank was trying to get the veteran to use was going to require 3% down. So every $100,000, that's $3,000. He was looking at a $400,000 house. So his closing costs would have been $12,000 more to go through his bank that did not offer a VA loan, rather than go out in town and communicate and ask around and find a VA veteran that was also a mortgage broker that not only had access to VA loans but likes helping veterans use their VA loans. So those are the four disadvantages of VA loan. To recap, you'll have less or no equity in your house because you're putting zero down. May or may not be a disadvantage. Cannot be used for vacation or rental properties, investment properties. You may find pushback or resistance from the seller or the realtor based on their knowledge of the program, their willingness and ability to pay seller-paid financing and or turn over a property that is set up and safe and meets minimum standards as determined by the VA, which we covered. And then funding fee is slightly higher, 2.15 versus 3.3 on the subsequent use. And then not all lenders offer them or understand them. And so with those disadvantages, if you're running up against those, it's best to find a lender that knows, likes, and understands them, has used them themselves, right here, and enjoys helping veterans take advantage of their benefits. You gave service to your country, and one of the benefits of that is the VA loan. And don't work with people that don't appreciate you as a veteran and your benefits, and will help you use them to the fullest extent. If you know somebody that needs help, or you run across somebody that's getting resistance, feel free to refer them to me. If you like content like this and you'd like to see more like it, go ahead and like, comment, share, follow. The comments down below, we will answer, text those out, respond in kind, or put those in the next video. So go ahead and subscribe so that you can see the next video. And if you have more questions, feel free to reach out to me, Brian the Mortgage Savage.